Everyone says the market is overvalued. Everywhere you look, headlines, X-threads, finance podcasts. The word bubble keeps appearing. But here's a question nobody's asking. Overvalued compared to what? Because that word alone means almost nothing without a reference point. In the next 7 minutes, we're going to look at the actual numbers, not opinions. Numbers. And they tell a more complicated story than the headlines suggest. Right now, the S&P 500's forward price-to-earnings ratio sits around 21 to 22x. That's above the 25-year average of roughly 16-17x. On its face, that looks stretched. And that's exactly what gets reported. But here's the problem with stopping there. In 2000, the same ratio hit 29x. In late 2021, it touched 23x. Context matters. Interest rates matter. Earnings growth matters. A market trading at 22x earnings in a 5% rate environment is a different animal to 22x in a 1% rate environment. So before we decide whether the market is overvalued, we need to look at 4 separate data layers, not just one ratio. So what does that actually mean for investors? Let's build the picture properly. The PE ratio. The S&P 500's forward PE of 21x is elevated, but the trailing Shiller CAPE, which smooths earnings over 10 years to remove short-term distortions, sits near 33-35x. Historically, a CAPE above 30 has preceded lower long-term returns. That's a yellow flag, not a red one. Price to sales. The S&P 500's price-to-sales ratio is also above its historical mean. This one is harder to explain away. Sales don't get manipulated by accounting changes the way earnings can. The Buffett Indicator. Market cap divided by GDP, currently above 175%. The long-term average is closer to 100%. Buffett himself has called this the single best measure of whether the market is cheap or expensive at any given moment. Here's where it gets more nuanced. 3 data points challenge the overvalued narrative. 1. Mega cap earnings concentration. The S&P 500 is heavily weighted towards 7 companies: Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet, Tesla. These companies have genuinely high margins and strong free cash flow. Strip them out, and the equal-weighted S&P 500 trades closer to its historical average. The index isn't overvalued uniformly, it's top-heavy. 2. To be interest rate adjustment. Standard valuation models discount future earnings using current rates. As rates come down, the present value of future earnings goes up. If the Fed cuts rates through 2025-2026, higher PE multiples are mathematically more justifiable, not irrational. 3. Earnings growth. S&P 500 earnings are forecast to grow roughly 11-13% in 2025. If companies deliver that, current valuations compress naturally. The E grows into the P. Overvaluation is a moving target when earnings are expanding. So what does that actually mean for investors? A high PE today doesn't mean the market falls tomorrow. It means the margin for error is narrower. 3 macro variables deserve attention. Right now, inflation stickiness. If inflation remains above 3%, the Fed can't cut aggressively. That keeps borrowing costs high, compresses corporate margins, and puts pressure on growth stock valuations. Core services inflation has been stubborn. This is the market's biggest unresolved question. Consumer credit stress. Credit card delinquencies are rising. Auto loan defaults are climbing. The US consumer, who drives 70% of GDP, has been spending on momentum from post-pandemic savings, but that buffer is eroding. Historically, consumer stress precedes earnings disappointments by 2-3 quarters. Geopolitical supply shocks. Energy and commodities remain exposed to disruption. A supply shock in oil reprices inflation expectations almost instantly. Markets are not priced for that scenario. None of these scenarios are base case, but they are underpriced risks in a market trading at premium valuations. History doesn't repeat, but it rhymes, and valuation has been the most consistent predictor of long-term returns. not short-term direction. Research from Robert Shiller's data shows that when CAPE exceeds 30, the median 10-year annualized real return on US equities drops to roughly 0 to 3%. Compare that to CAPE below 15, where median 10-year real returns have been 10–15%. The key word is 10-year. High CAPE doesn't predict a crash next month. It predicts lower compounding over the next decade. That's a different and more useful insight. Here's the nuance most investors miss. In 1996, Alan Greenspan called the market irrationally exuberant. The S&P 500 then doubled before the eventual crash in 2000. Being right on overvaluation and being right on timing are two completely different skills. Data points that support the overvalued narrative: Shiller CAPE near 34, historically high, price to sales above the 20-year mean, Buffett Indicator above 175% of GDP. 3 data points that challenge it. Equal-weighted S&P 500 is closer to fair value. Falling rates, mathematically, justify higher multiples. Double-digit earnings growth could compress current multiples naturally. The calm, evidence-based verdict: the US equity market is trading at above-average valuations on most measures. That historically implies below-average returns over the next 5 or 10 years, not an imminent crash. The risk is not that the market falls 40% tomorrow. The risk is that investors expecting 10 to 12% annual returns over the next decade are likely to be disappointed. Manage expectations accordingly, diversify accordingly. The biggest mistake is binary thinking. Investors hear overvalued and either panic sell or completely dismiss it. Neither is rational. Valuation tells you about expected returns over long horizons. It tells you almost nothing about what happens in the next 3 to 6 months. The market can stay elevated far longer than any analyst predicts, and then correct violently and quickly. The data doesn't give you a timer. It gives you a probability distribution. That's a very different thing. The second mistake, anchoring to a single metric. One ratio never tells the full story. You need multiple data layers to triangulate a position. That's the entire premise of how we approach this. Here's the one-sentence takeaway. The market is elevated on most measures, and historically that means lower future returns, not an imminent collapse, but a thinner margin for error. If you want to see the signal score applied to a specific sector, whether tech is more overvalued than energy, or where value actually exists right now, that video goes up Thursday. Subscribe so you don't miss it.